morning, everyone. I hope you all geared up for day 2 of ChangeNOW. I hope you had an amazing day 1 if you were here yesterday. I'm Sabine Flechet. I'm the co-founding partner of Masawa. I'm also the senior venture advisor at the Purpose Foundation. And leveraging these 2 roles, I'm here with my team and with the panelists to decomplexify a topic called corporate ownership and governance, and to try to understand how the deep design of your organization can actually foster long-term purpose. So, do we have any founders or entrepreneurs in the audience? Raise your hand. Yeah, a couple. So, have you ever questioned the organizational structure of your company? And have you ever thought that this was actually counterintuitive, nonsensical, to the purpose, the mission of your company? Well, we usually kind of think about what we invest in, right? Climate tech solutions, sustainable businesses, sustainable materials, but we never really think about how we invest and how the organizational structure, the corporate ownership, the governance model can actually influence the long-term purpose of your company and can be actually counterproductive to your mission to save the planet, to do good to the society. So let's dive into this. What is actually ownership? And I'm sure you've learned this at business schools, across countries' culture. It's a mix of rights and responsibilities, right? It's an economic right, because it can provide you access with dividends and capital gains, but it can also be a voting right, right? A voting right that provides you control over certain decisions of the company. It's also a right to pass on or to destroy. I mean, as an owner, you can pass it on to your inheritance. You can also exit, you can sell, and you can also donate. So this means that it could lead to blood and money being the key determinant of the allocation of ownership, right? Blood and money becomes the power by which someone owns something. And this is also counterintuitive, because then all stakeholders, all people that are incremental to the value of the company, are working towards one single goal: maximizing the owner's value, right? The company needs to be profitable, and who is rewarded with these profits? The shareholder. And so it means also that that value is extracted, right? So it's going outside of the company. It's not recycled, it's not reinvested into R&D, product, team, recruiting, and it rewards stakeholders that have probably also nothing to do with the company, what we call absentee owners. So this type of organizations can actually pursue more the profits versus the purpose, and that leads to a lot of kind of negative patterns, negative behavior. The first one, since you need to maximize shareholder value, you will probably have to follow growth at all costs, right? We all know about hockey stick, quick exits, and winner takes it all. We also see some negative behaviors that favor higher risk, higher cash burn, and so crunch gap situations. So everything is pretty much short-term oriented to maximize the shareholder value. There's no patient capital. And of course, I mean, we here at ChangeNOW, it's far from being sustainable. It's prone to what we call VUCA. VUCA is volatility, uncertainty, complexity, and ambiguity. And by ambiguity, I mean also that it's foster an imbalance of power, but also intransparency in the relationship between the founders and their shareholders. So my question to you, and especially the entrepreneurs around here, is there a more sustainable way to think about corporate ownership and governance model, which could mitigate the risk that I just mentioned, but also foster long-term purpose over the short-term profit? What if we could think about a sustainable corporate governance and ownership model that would allow for non-extractive economic model? What if the founders, you guys, could remain captain of your own boat, and that the value kind of created within the company would not be speculated upon and would not be directed to people who are not connected to your company, these absentee owners? And what if the profits were serving actually a purpose, right? The value created would be reinvested into the organizations or donated for another mission. So is that an utopia? Well, actually not. And I'm really, really proud to present to you a couple of companies that dare to follow that corporate ownership and that governance alternatives. And these companies, and I'm pretty sure you know some of the names here, like Patagonia or OpenAI, among the top one, share some type of alternatives, corporate ownership and governance model. They can be steward-owned, and we'll see this in further detail during the panel. They can be employee-owned or cooperatives, and they can be also foundation-owned. So is that a new asset class that we're imagining? Is that just in our head? Actually not. A lot of people, experts in that ecosystems, have actually thought through and redesigned the entire venture capital system. And just to name a few, for example, Aner Ben-Ami from Candid Group, venture capital should never have become the standard way for us to fund new business, or Albert Wenger from Union Square Venture. Venture capital is basically a hammer, a very big and a very strong hammer, but not everything is a nail. Also, I think for a lot of companies, taking venture capital is a mistake. So what does it mean in concrete terms? What are the new rules of engagement for these alternatives form of corporate ownership and governance model? First, ownership should remain or could remain within the company. The economic rights and the voting rights could be actually handled from two different hands, which means that basically you have the concept of stakeholders versus shareholders, and you have also this concept of self-governance, which means that the governance is decided by those that have incremental value in the company. Furthermore, economic leverage is a non-extractive model, right? So you would have investors who get repayment of their investments, plus maybe an upside, but from free cash flow or from new financing, which calls for non-dilutive financing instruments, like revenue-based financing, cash flow-based financing, share buyback, convertible loans, or profit-sharing agreement. There are many, many other forms of non-dilutive financing instruments. The profits would also serve the purpose, which means that the returns would not be maximized or unlimited, but risk adequate. And you would also have a time horizon which is a bit more appropriate for such sustainable businesses, right? So patient capital. And we'll come through a little bit of the different models that exist around the world, like the golden share model, which will be explained by the Purpose Foundation, steward ownership, employee ownership, foundation owned. In France, we name this Fondation Actionnaire. So can we prove that these models are working? Do they have actually an impact? Well, there are a lot of studies, especially done by the Copenhagen Business School, which basically show that these alternatives result in better management of the company. So you have higher resilience in times of crisis, long-term orientation, you have less failure of startups, better relationship also among stakeholders, and notably with employees, because then they are much more motivated. There's a social mobility which is encouraged, and there is, of course, higher retention. And of course, there's a strong societal impact. What if then we would not have the consolidation or the concentration of wealth just among a minority, the shareholder? So can we implement this? Why are we not having those structures more frequently? Like, why is that maybe the first time you've heard about these alternative models? Well, challenges remain, and we'll talk about this in our panel. First, most probably you haven't heard about it because there is a lack of information. There is a lack of narrative, of language for these case studies. Second, it's also very complex to implement, regulatory and legally. And finally, there is also not so many investors who dare to align their capital to the mission of the company. So we definitively need the advocates, the ambassadors, like my expert panelists, to pave the way for these changes to happen, and that's the reason why we're here at ChangeNOW. So I'm very thrilled to welcome 4 expert speakers, change agents on stage for 2 panels, where we're going to discuss these challenges and the mitigants. And we also discuss how they manage to invest in such alternative models and what they got out of it. So first, we will share the perspective of one entrepreneur and one VC investor, discussing this relationship between investors and founders. And then we will also have, and we'll go a little bit, travel a notch above the value chain, discussing the challenges of the VC investors with their own clients, their limited partners, those that invest into their funds, with two also renowned impact investors. So, without further ado, I'm happy to welcome on stage Maike Kauffmann, co-lead at Purpose Foundation, and Christian Sigmund, CEO and co-founder at WILDPLASTIC. Please, have a seat. So, welcome on stage.
Thank you.
Thank you.
After this brief overview of what we're going to talk about, I'm super delighted to have you both talk about this relationship between investors and founders. And let's maybe start with a quick intro as to what is your role in these alternatives to corporate governance and ownership. So, Maike, you are co-lead at the Purpose Foundation. The Purpose Foundation was founded in 2015. Since then, it's worked to build an economy that serves the people, the planet, and the society. You've leveraged, basically, through the Purpose Foundation, this examples of alternative ownership structure. And you first defined, with the Purpose Foundation, and coined the term steward ownership, right? And you have, through the years, then been able to leverage that notion of steward ownership through different activities. The Purpose Foundation is known for consulting works, for non-for-profit activities, and you have two investment vehicles, the venture and more of the private equity arm. So first, maybe for those that are uninitiated with steward ownership, can you give us a little bit more of a concise explanation of what this is and what has been your journey at the Purpose Foundation to promote that concept?
Sure. Thank you very much for having me here. Maybe I can start off with kind of the journey of the Purpose Foundation because it brings us to steward ownership quite nicely. The Purpose Foundation and the whole Purpose Network was founded really with the question of how can we build companies that are contributing to an economy that serves people, planet, and society, that basically contribute to, solving problems for society and for their customers, not to creating problems to make profits. And we very quickly realized that in order to do so, we needed to look at the deep design of companies. We needed to look at the question of, who has power and why, and what is money in the company, what's the role of money in the company? And these questions are kind of on a deep design level on ownership and financing. So we started to look around for examples of ownership structures around the world, and we first found a lot of examples that we didn't find so inspiring, examples where money buys power over companies. Whoever has the most money has the most power over these companies that influence all of our lives. Or examples where companies were really only existing to create wealth for the shareholders and didn't have a bigger purpose than that. But then we also found really cool examples, and some of them you already had on your slide. So examples like Robert Bosch with 400,000 employees in Germany, examples like one of the largest pharmaceutical companies in Denmark, Novo Nordisk, our John Lewis partnership, you also had them on the slide. And all of them really fundamentally rethought ownership, and that is where we come to steward ownership, because we realized when we started to look at what they do differently, we realized that while they all had really different legal structures, they all shared kind of the core understanding of what the company was and what ownership over the company was. And they all shared two principles. And the first principle here is the principle of self-determination. That means that the voting rights over these companies, so the last instance of power over these companies, always remain with people connected to the company and kind of actively taking on responsibility in these companies. So voting rights and power is not speculatively sold, it's not automatically inherited by anyone, but always remains with people close to the company, and the company is kind of self-determined. First principle. And the second principle is the principle of purpose orientation, and that means that the value created in these companies serves the purpose of the company. It's not there for the shareholders of the company. It's not kind of a goal in itself to make profits and to create shareholder value, but actually profits are a means to an end in these companies. They are reinvested, they're used to cover capital costs, they can be donated, etc. They can be used entrepreneurially, but serve the purpose of the company. And now all these companies, what we found really impressive is that they don't just write these principles on the wall and kind of follow them, but actually legally enshrine them in the long run over generations of entrepreneurs. So we realized, well, okay, they all share the same thing, but they don't have a name for it, they don't talk to each other, they don't know about each other. So we thought, well, let's give them a name, let's give this concept a name and define it and start talking about it. So we came up with the term of steward ownership, and we started to talk about it and write a book about it, and then kind of developed a whole nonprofit around it. And then sooner or later, entrepreneurs started coming up to us and say, we want to do this. Like, how can we do that? Help us. So we helped to design kind of legal structures for implementing steward ownership. We started to consult companies on their path to steward ownership. And then at some point, entrepreneurs came up and said, well, we really want to do this. We know how to do it. But how can I get investments in this structure? And for a while, we always said, that works. Like, we know there are solutions for that. And at some point, we realized, well, there are solutions for that, but really we have to create more examples. So we started to invest exclusively in steward-owned startups with one fund, and exclusively in steward-owned small and medium-sized businesses with the other.
And we have a living example here with Christian. Thanks a lot for joining the panel. So you're a co-founder and CEO of WILDPLASTIC, a steward-owned company, which is also kind of invested by Purpose Venture. Can you tell us a little bit, like, how did you come up with this idea? Because at the end of the day, you essentially gave away the right to exit. What was the thought process on this journey to become steward-owned?
So first of all, good morning, everyone. I am Chris, the co-founder of WILDPLASTIC. And first of all, what do we do? WILDPLASTIC, the name kind of gives it away. We recover plastic from the wild. 80% of the world's plastic is out there in the environment. We try to get it back and recycle as much as possible from it. But this is not what I'm going to talk to you about today. It is much more about the deeper layer of what else we did differently. And we started the company in 2019, and our ambition was not to just create a plastic recovery company, but to deeply also think about, well, the system that is here, that is deeply flawed, how do we fix it in the future? And obviously we won't do it with the tools of the past. And if companies contributed to the problem, how do they deeply contribute to a solution in the future? And that is a systemic question. And so we all asked ourselves, well, what do we do differently when we start this company now? And I think that thought process brought us to the question of, well, how do we make sure that WILDPLASTIC recovers plastic until the job is done?
Like a long-term orientation?
In the long term, this might take 100 years or less or more, I don't know.
So you want the company to actually exist beyond your even lifespan, hopefully.
Yeah, well, I mean, it would be cool if we fixed the problem earlier, but let's say this will take 100 years. How do we make sure that purpose is being the main focus until the very end? Embedded
maybe also in the bylaws? Is that part of the Articles of Association?
Exactly. And now, the problem is this was not available even as a model to choose from at the very start. What you see is you start a company and you VC fund it. That is one way, or you bootstrap it, or you are a non-for-profit. And those were kind of the three options I saw.
Or you're already profitable and you can get some bank debt.
Well, but when you start the company, you're usually not you're looking for the
like
first customer.
Unit economics.
But so this is actually where we were lucky enough to get to know the Purpose Foundation, who kind of explained to us that ownership is that key question that we were actually looking for the answer for systemic change in what we do in the long term. Because this deeply drives of how WILDPLASTIC is going to function in the future, even beyond me and beyond everyone else that's working there.
So not only you're working on the what, I mean, providing some sustainable materials for changing the way we live, we consume, we produce, but you also look at the how and how this sustainable mission can be kind of long-term oriented and fulfill that mission for the long years to come.
I mean, Sabine, the point is, we started this journey because I believe in the notion of regeneration instead of further extraction. It's kind of, hey, let's regenerate the world's wild plastic instead of extracting more oil to produce more virgin plastic. That is the simple belief that this is the right thing to do. If that is our belief, what is the adequate or corporate model to follow suit? I think this is, that was kind of our thought process.
And I'm guessing this journey has not been so easy to implement. Otherwise, maybe some of the entrepreneurs around here would have also chosen that path. What are the can you kind of deep dive into the specific challenges you faced, being, on finding out that Purpose Foundation was existing?
Yeah.
I mean, we were talking a little bit earlier about the lack of information, and I'm pretty sure that a lot of people never knew you existed, but also kind of the legal framework, like finding additional capital, etc. And maybe also, Maike, just with the examples from all the companies you invested in, like what have been the challenges so far?
4 challenges. Number 1, we had to be lucky to run into the Purpose Foundation. It was pure luck. It might have as well not happened, and then we would have chosen from the conventional options. Number 1. Number 2, what we did is technically not an available option. It is a hack that we did with the Purpose Foundation with the golden share model. Golden share meaning we give away 1% of our shares, and with this 1% to the foundation, and with this 1%, with that veto share, the foundation guards the 2 principles of self-ownership and reinvesting profits into the purpose.
So it has a veto right.
Yeah, they have a veto right, but this is a hack. It's not a public corporate model that you can choose from the list. So that's a problem.
And why is that? So there is no legal framework, maybe, Maike, in terms of like having different options to choose from a startup perspective? Like the legal framework, the regulatory framework doesn't help.
I mean, there is not, but there might be in the future, Maike.
Yeah, exactly. So, I mean, next to the information lag, definitely the legal infrastructure for steered ownership is currently all over the world, to be honest, not very good. So we do have some countries where it's a bit easier, where we can use kind of enterprise foundations, so foundations that are targeting, or that exist to hold ownership over companies.
Like Fondation Actionnaire in France, probably?
No, the French one are a bit different. That's getting too technical, but in Denmark we see those, for example. Or I'm sure a lot of you guys have heard about the example of Patagonia, and they use the trust structure in the US, so they use the perpetual purpose trust. You can also use employee ownership trusts, or the golden share model. And in Germany we're currently in the government has actually decided to implement a legal form for steered ownership separately from other legal forms. But we're not there yet, and so it's still a path to go. But we definitely need to improve the legal structures, yeah.
And that's part of your work at Purpose
Yes.
Foundation to kind of promote this new legal form.
If I can interrupt you, I think Maike is playing this down a lot. It is a gigantic, massive achievement to not only get the political buy-in, but to get it actually on the roadmap to create a new corporate model. I think the hopes are this happens within the next 1.5 to 2 years. But what this changes is that the Chris of the future who sits in front of the list of corporate models to choose from, it is a list.
It has the option.
Yeah.
Has the option.
Yeah, it's a state-based kind of model.
So
it's not something that private organizations are trying to kind of bring into the world, but it's actually something that's a valid kind of state-based option.
And also maybe to make that clear, what Patagonia did is amazing, but they also did it, 40 years after incorporating, being highly profitable, and then having the luxury of making that decision. What about someone who starts a company and who has essentially, €0 in the bank? How do you do that? This is the big change that is coming.
Because you wouldn't have the non-experienced lawyers that will charge you a lot of
the
euros
monetary
or
funds
dollars.
to start a foundation, and so I think it is a game changer, especially for startups and entrepreneurs and small and medium companies.
So they need to move to Germany because I don't think it exists in any of the.
Yeah, but we're getting more initiatives around
yet.
Europe, to be honest. There's also an initiative for a new legal firm in the Netherlands, and I think in some Liechtenstein, I think.
Okay, so it's moving, it's going in the right direction. What did change in the relationship to your investors when you became steward? I guess during this journey when you decided to become steward, you kind of created a little bit of anger from the VC scene that could not invest anymore into WILDPLASTIC, but I'm sure it had also some benefits. Could you tell us a little bit about this?
Yes. So I think the VCs weren't as angry because they, just like us, they realized it is not a typical VC business case. So what we're doing is we're not creating a new technology that is going to exponentially solve the plastic crisis week by week, but we actually have a profitable long-term model of recovering ton by ton from the environment, which is going to take decades time. It is not a VC model, so they weren't as angry, and it simply wasn't suitable for us as well. And the challenge I wanted to share as well is, well, after incorporating, after getting that done, well, how do we fund the company now? Because if VC money isn't available, rightly so, and we're also a non-for-profit and we don't have the funds to bootstrap, what do we do now? And I think this is, this was the big revelation for me, that actually there is investors out there, there is partners out there who think alike and who kind of have the same vision of.
Who are these type of
one of them is
investors?
sitting over there. Patrick, he's going to talk in a second.
Exactly.
But it is business angels. It is some organizations like Purpose Ventures, but it is also. How do I say this? It is daredevils like Planet A Ventures who said, hey, we're going to dedicate.
VC fund.
It is a VC fund, and they dedicated a small percentage of their funds
assets under management, yeah.
As a prototype, as a, let's test this out because we believe in the systemic change of this. So it is essentially, it's a big range of investors who think, hey, long-term impact, patient capital, and adequate capped returns is something we believe in too. It is something that changes the game.
Yeah, and maybe also just investors and investment funds that realize that the models we currently have, they are not really suitable for all companies they want to invest in. So kind of investors that are also, as the entrepreneurs, are looking for more coherent structures to their intentions, so more intentional ways of investments as well. So we definitely see connects there as well.
Yeah.
And maybe, Sabine, to your question, what changed? Because I just explained that we did find investors in the first place, which was a huge achievement. But what I did observe is, well, the relationship is quite different because there is a power shift, because the voting rights, they stay within the company, they stay with us. So technically the control over the company is still ours. And what this made for me is that it actually created a level playing field, and the relationship, if I had to describe it, is very collaborative and very, just solution driven. We come with the problems and challenges and consultations and questions to spar with our investors and find the best solution for WILDPLASTIC.
Because the relationship is much more balanced, right? So
because we're kind of
still have the control.
We're circling around the problem of how do we drive WILDPLASTIC forward best, and what does this organization need right now, and this is the incentive everyone has. And that is quite different, I believe, because there is no other.
You're aligned. So you have an alignment of
sometimes hidden power dynamics happening.
Yeah. But so just to come back on the type of profiles of investors that are interested into steward-owned companies and are co-investing with you, are they looking for returns or are they looking for doing good, right? I mean, we're not saying it's philanthropic money. They are actually looking for returns. So how do they get their returns if they cannot exit?
Yeah. So maybe that's one of the biggest differences from kind of investments that are aligned to steward ownership, to conventional equity investments, is that the liquidity for the investors stems from the company itself. So at some point in the future, maybe over several financing rounds, the company pays back the investor plus a return for the investor. And what that means is that everyone is aligned to the company having to become profitable at some point, and to the purpose of the company. And so the kind of the liquidity generation is one of the main differences, and then the return is also really different, because in our conventional investment world, we have potentially unlimited kind of skyrocketing returns, right? We bet on the company growing and growing and growing, and then we sell it, and with selling it, the next person bets on the company growing even more so they can sell it again. And there's this unlimitedness in the return, whilst in steered ownership, investors and entrepreneurs together have to talk about what is enough, how much is enough, how much is risk adequate for the investments I do, for the risk I'm taking. And that can be extremely high. Like, I'm not saying that it has to be really low, but at some point there's a limit, there's a cap to the investor's return, and that can be a cap in numbers, that can be a cap in time, that can be a different process of how kind of the relationship is ended, but there's this potential of the relationship between the investor and the company ending at some point.
And this is something you discuss before the exit happens, right? So you actually put the discussions around valuations at the forefront of the relationship between the fund, and I guess this also calls for transparency and managing expectations.
Exactly, and I think naturally, so I mean, you start off and there is nothing, there is an idea and a team, and there the risk is quite high, and then over time you prototype, you find product market fit, you may find first customers, you create revenue, and the risk decreases, and at one point, I think the returns are maybe closer to a bank loan than they are to a high-risk early investment. Yeah, well, and I mean, this is our ultimate goal as well, to become bankable, to be able to get a loan from the bank, which is the cheapest money from which we can drive our operations.
Yeah, but just to kind of also include the other side, we also know of more venture-like cases. I mean, WILDPLASTIC, you were a venture-like case in the beginning, but now you're already a bit more stable, maybe. But for example, OpenAI, they are like financed in a steered ownership aligned way, and are structured in a steered ownership aligned way. And in the beginning, the investors were promised 100x return. So you can really have like extremely high potential returns as well, if the company at some point becomes profitable and can actually pay investors back. So there's still this risk of venture capital, obviously.
I have a last question, which is a bit like playing devil advocate, because we see a lot of this recycling of capital. So I'm accumulating wealth because I'm an entrepreneur, I've been successful, I've been serial entrepreneurs, and I decide then to reinvest my wealth into the next startups, right? I mean, this is how Silicon Valley has been built. We've seen examples here in Europe, you know, the BlaBlaCar, the Flixbus, the N26, a lot of these founders or first-time employees have accumulated wealth, and they are able then to start their own startups. So that's kind of invigorating the innovation ecosystem. What happens if, you know, all these companies are steward-owned, which means that most of the value stays in the company, and these people don't get wealthy to reinvest in other startups? How do we do this?
Well, I would say it is down to the company to reinvest those profits, and that is
to spin off then another, like an intrapreneurship.
Right? I mean, it might be closer to their purpose, and it might be closer to their area of interest, but I think what we're talking about is the profits are there, and the question is, what are they being used for? Yes, there is amazing examples of spin-offs and recycling of investment, but that can still happen. I think the decision is just made
within the company, by the organization,
maybe by a board of people rather than one single founder.
Yeah, and we definitely see examples like that, like Ecosia, the search engine that plants trees, that's kind of diversifying in kind of what they are doing, or also the bigger examples like Patagonia or Bosch, and how they diversify their approaches. And I also, a different answer to that as well, that's leveling the playing field, isn't it? Like, then we don't have some, like, very few entrepreneurs that because they have the funds can build the next company, but we actually have a level playing field where the people with entrepreneurial energy and kind of vision and really entrepreneurial spirit can build the next company. And that can be people that have built companies before, but it can also be others. And I think that kind of level playing field is something that's really beautiful around steered ownership.
And I think it's also like the concept of this stakeholders versus shareholders, that it's not concentrated, the wealth is not concentrated in one individual. So for example, in our fund at Masawa, we give 10% of our GP carry to founders, which means that we believe in solidarity capital. And then we have also a cap actually on our returns. So our returns are capped. Anything above a certain multiple on invested capital goes to a foundation, which has the same mission, but through different projects, because with Masawa, we cannot invest in every single project. So they would be able, for example, to invest in non-for-profit. So these are the type of structures where like the concentration of wealth is not uniquely singled out by one individual, but actually spread across the different stakeholders.
Yeah, and focused on the purpose of the company, focused on what problems the company wants to solve for its customers, for society, for the planet. So it's basically not focusing wealth for private individuals, but focusing wealth for a purpose, for something that's done with it. I think that's the main difference.
So for the entrepreneurs around in the audience, what type of business model, what type of companies are more applicable to these new alternatives, corporate ownership and governance models? Do you have a specific, do you need to be a specific company to be actually steward on?
I think before I saw the case of OpenAI, I would have said, well, you know, there is maybe a smaller range of business models.
A profile?
The type of profile is maybe a bit more narrow. I think that's not true anymore. Technically, you need to be convinced that it's the right model for you, for your business.
So it's not going to replace venture capital.
Not in every place.
It's a new asset class between
it is
different
absolutely
others.
about diversity of models and choose the right for you. Much less so than saying, hey, one size fits it all. That never worked.
The nail and the hammer.
The nail and the hammer.
Yeah, absolutely agree. And putting other words to that, I mean, we've built up a monoculture of companies and of ownership and financing for companies with one very specific model and a specific narrative around ownership and financing. And steward ownership basically opens up the options you have, creates a permaculture of companies. So I agree to that. And I would also, I mean, we see so many different companies, like startups, medium-sized businesses. We see a lot of companies using the model for succession as well. So we've talked a lot about startups here, but really Patagonia, for example, that was a succession case, obviously. And in really all different fields, but I think particularly fields where you have users or customers where that you want to make a promise to. You want to promise that the company is there for a purpose, and that it's not like you don't use them as a means to create shareholder value. And also, I mean, we talked about OpenAI, so I think the whole artificial intelligence sector, digital platforms, etc., where there's just so much uncertainty of where that will go in the future, where it's really beneficial to have a structure that gives you a bit more security as to what is done with it.
Yeah, also like decentralized model, which would be also kind of enabled by blockchain. A few last words for our audience. What would you wish for, or how can you basically promote this to other entrepreneurs, other co-investors?
I would love to have more conversations around and honest conversations around the question of, hey, where do you want to go with your business? What is actually your plan? And you know, what is kind of like, what is the model you dream of if you could wish for it? Because I think right now there is just boxes to choose from, and there is much more in between. And I just want to encourage all entrepreneurs
to be creative, to think outside of the box.
Creative, to think outside the box, and also to be brave and believe that there's more people out there with the same vision. Because I think ChangeNOW shows it. There is a lot of people moving into the right direction, and that goes also for corporate models.
Yeah, I can also only second that also for investors. I mean, we see this huge movement currently starting to roll around alternative ownership and financing structures. We see more and more business angels, funds approaching us saying, hey, we want to invest in steward ownership. Can you tell us how to build up the investment fund and the financing structures for that? And I think it's just something where everyone should at least take a look at the different models that there are out there, and this really realize that whatever ownership and financing structure you decide on, it's a choice. There's not just one path that you have to go because everyone is doing that, but you have a choice who has power and why, and who has money and why, both as entrepreneurs and as investors. And also, just last message is that we're still also finding new solutions, and it's kind of an emerging field, even though it's backed by historic kind of examples, but it's still quite innovative and new, and we are finding new financing solutions, we're finding new fund structures, we are finding new legal structures, obviously, as well. So just an invitation to everyone who wants to join this, wants to learn, wants to think about it, to do so.
Yeah. And you're going to be a little bit here after the talk, so that you can talk about a little bit the way forward with all these entrepreneurs around that want to maybe envisage steward ownership. So thanks a lot, Christian. Thanks a lot, Maike. That was a wonderful panel. And I will welcome our next panel to kind of travel a bit higher in the value chain, talking about VCs and their clients. So thanks again.
Thank you very much.
So after discussing governance and ownership from the angle of the founder, VC, venture capital relationship, let's go and deep dive into the perspective of the VCs and their clients. So travel a notch upper on the value chain, the VCs and their limited partners, those that invest into venture capital funds. So I'm super happy to welcome on stage Astrid Leyssens from We Are Impact Collective and Patrick Knodel from the Pandion Innovation for Impact GmbH. Have a seat, welcome. So as I was mentioning, we had a first panel talking about founders, entrepreneurs, and their investors. We're going one way deeper in the value chain, talking about the VC investors and their limited partners. So welcome on stage, Astrid and Patrick. Astrid, you're active in the world of social enterprises, family offices, impact investing network, NGOs, and corporates wanting to create a societal and planetary value. So really looking at probably every single type of and profiles of investors out there. You're the founder of We Are Impact Collective, an ecosystem putting impact at the center of the game. It's a collective of experts that guide all stakeholders in the ecosystem on their impact journey. You're also a limited partner, so you also invest in different impact VC funds, and you're leading also VP Capital, which is a family office contributing to and investing in impact. Patrick, you come more from the business side. You had a classical education with business degrees. You worked in various industries, from sports via gastronomy to real estate and events. And you told me through a backpacking trip, you started questioning a little bit the worldview, the so-called Western values. And you figured that these are not really corresponding to the real world, especially probably in the Deep South. And today, with the non-for-profit Knodel Foundation, you advocate systemic change, and through Innovation for Impact GmbH, you invest in business models that basically combine and reconcile economic return, but with an impact angle, being social or ecological. And you're also an investor in WILDPLASTIC, in the company of Christian that we've seen. So, you know, we've talked about steward ownership, we talked about other alternatives forms of corporate governance and corporate ownership. What has been your journey so far with this concept? Is that something that you follow actively? Is that something that you only invest in? What has been your exposure? So, who wants to start? Astrid.
Thank you for the question. I started 10 years ago in impact investing, really thinking of where should my money go in societal or planetary solutions. And since a year or two, I see the impact investing field growing. And I was thinking, are we now building the field or the systemic change that we really want? And in the wealth owners discussion I have, it's a lot about the VC language, like 8 out of 10 will fail, and the risk or the return should be rather high. And you start to listen and learn that actually the language that's now in this impact investing field, it's maybe in the end not what we really wanted to build. Because we wanted to build something more in power balance and also creating a little more an equal society. So that's a little bit where I am. Since 2 years I follow this kind of companies and I'm looking into organizations that are employee owned or steward owned or steward equity in different forms, as I do think it's the phase now for our impact investments to go.
And you, Patrick, what has been your, since the backpacking trip, what has been your exposure to these new forms of alternative ownership and governance models?
Yeah, there were many backpacking trips, but thanks for the invitation. Yeah, well, I got into this field in 2016-17. So 2016 was for me the tipping point where I decided that I don't want to earn money anymore with any normal job that extracts value from somewhere else, and I wanted to do something useful. And from that, the idea came to set up this charitable foundation. And from that charitable foundation, with many talks with other foundations, I got to talks to people in social business, impact investing, and so on. And I heard the phrase for the first time. So I visited 4 different economic universities in Germany and the UK, and I haven't heard one single lecture in my whole life about sustainability, about psychology, sociology, whatever. So I started from zero and just tried to find out, okay, is it possible to actually invest into businesses that put some value to the world and not extract it? And the way it's going now in the foundation, we have 22 funding partners, and in the for-profit investment, I have like 17 investments. Out of those, 3 to 4 are fund investments. The other ones are direct deals, and I have all sorts in there. So I have the classical VC model. I have invested into impact VC funds, and I have invested into 2 steward-owned companies, and also, we can talk about that later, other forms where maybe, I mean, there is something in between. I mean, when my father built his company, he wanted to build a company for him. He never wanted to sell it. I mean, that's how companies had been built all over time before the VC model, and that's totally forgotten. Like, it's not only, you cannot own it or you have to sell it, there's also another option.
Okay, and among your portfolio of assets, being impact, non-impact, being steward-owned, or any other forms of alternative to corporate ownership, like what do you see changes in the way, in your relationship to the founders, in the returns, in the impact that is being actually pursued? So do you see really like a lot of differences among these on the how versus the what we invest in?
Yeah, I mean, I see 3 main things that are actually, I mean, my portfolio is all impact. Only I have 1 tech that was in the first year. The rest is all impact. I mean, there are 3 main things, and some of them have been covered by Chris and by Maike. I mean, the first one is that many useful things to do that they cannot be scaled in a way that a VC wants them to scale. I mean, WILDPLASTIC is one example, but WILDPLASTIC is still something that you can scale to a certain extent where you can have a certain multiple as an investor, but there are many things. I mean, many companies also here running around, they're not even sure the problem they want to solve. Is it for profit? Is it non-profit? If it's for profit, how much profit can I get out of that? So I think many solutions, especially also hardware and social solutions, are just not valid for a VC model, which means they don't get funding if everybody just raises 200, 400, 1 billion VC funds. So they always talk about the big numbers, but they forget all the people they never give money. So that's one huge thing that I've seen. The second one I would point out is that the VC logic itself is very extractive. Mm-hmm. It comes from the world of business that we used to bring the planet to where we are. There's a quote from Albert Einstein. He said, "We cannot solve the problems using the thinking that we used to create them." Maybe it's not completely correct, but more or less. And I think that's very true. And many people in the VC industry, they come from a financial background. They are trained to use those tools, and they just apply them on Impact Now, and it doesn't really fit. And even if it fits, even if you scale the company, I mean, that's what Maike was talking about. Think what happens then. In the end, we live in a world where we have extreme inequality. We have an eradication of democracies because global corporate constructions can basically go to whichever state they want and move their supply chains around whatever they want. And if a democratic state passes a law, they say, okay, we go somewhere else. So that's the world we live in. So this is something we have to change. And if we only fund everything with the VC model, then after the VC, there comes the private equity investor, and after the private equity investor, there comes the billionaire or Google or some corporation or Nestle or whatever. Do we really think that by selling all impact companies to the people who create the problems, we solve the problem? I think that's just incredibly naive. And thank you.
that deserves a round of applause. Yeah, thank you.
And the third point I want to make is, Chris referred to it, this imbalance of power that we have on a global level, we have it also between funders and people who receive the money. I mean, I run a charitable foundation as well. It's an even bigger issue. I mean, if the white dude from Germany gives money to a small NGO from Mali, to get to a level of understanding with each other, that you work together and that there's not this huge disbalance of power, takes a lot of work and effort from both sides. So if I, for example, take WILDPLASTIC as an example here, WILDPLASTIC was the first investment in 2019. It was the second steward-owned investment, but it was the first investment that was handled in a way that, okay, we got to a point where we saw, okay, there are 4 investors who want to do this together, who are able to bring in the money that they need at that time. And so from day one, we said, okay, we are only doing calls together. So there was not one call just with me and Chris. It was only the 4 investors together with the founding team. And we discussed from the beginning what is useful, what do you need, how do we structure this, what kind of returns can we actually ask. So what do I need, what do we need in our structure as a minimum, what can you give based on your business plan as a maximum. So you cannot do what I call the Berlin-San Francisco stupidity, where you just put a graph that goes up to some endless point.
The hockey stick.
On the horizon. You cannot do that because Chris knows he has to pay me back what I invested and the multiple from his own business. So he has to be very, very clear, and he has to rethink a lot what he's actually planning. And that creates an understanding of investors and founders being on the same side of the table.
At the same level.
It creates a common sense, and I think the whole thing about impact founders are being so under pressure. They have to work against the system. All the incentives are against them. And that puts huge pressure on them. And I mean, they're all close to burnout. And then if you then also on top have investors who just push you all the time to create a multiple of 5x each year, I mean, that can't work. And this is really, really different in that setup.
And Astrid, do you see also this collaborative approach between founders and investors among your portfolio and among your assets?
Yes, I do see a real difference when it's a general VC kind of type. When it's more in steward-owned or employee-owned or collective or cooperative or whatever, you see that the balance, like you said, Patrick, the balance of power is different. Because the decision power is much more in the company and not in the investor's role. So that's really changing. I also think that the discussion or the reflection that the investor has, like what is enough, that it's something coming now into the reflection. And we used to have that kind of discussions in the philanthropic world, like I have too much of my wealth and how much do I want to give away. And now I see that the same thing is happening in the investment world. And it's kind of nice because then you can give back the power to the people who just have the entrepreneurial idea, they want to build a company, and they the company will also be alive for a longer period, because for those companies and funds, it's going from Series A to B to C, and there's always pressure on timing and getting money and funding, and it's taking stress out of the company as well, but also putting money in the company to make it more long-lasting and more innovative. So I do think that the reflections of people working on this field of this new kind of funds or companies is really having a different narrative than the traditional VC, and that values are much more in the discussion than it used to be.
Yeah, I mean, we all argue that venture capital is a people business, but we usually forget about the people within the business. I mean, impact founders have actually like two edges, right? Two type of pressure. First, they need to build a financial viable business model, and on top they need to have an impact. So it's a double-edged pressure for them. And this concept of enoughness, what is enough actually for an investor to be living adequately, to be happy with an investment that he's making? You've been doing, these types of investments in alternative forms of corporate ownership and governance models for quite some time. How have you convinced other investors to come along? Because it's not just, we need scale. We need, referring to WILDPLASTIC, who did a recent funding announcement. How do you actually convince co-investors to come along on your journey? What do you need?
The best way, I think, is to have the reflection and the thought-provocative kind of conversation. It's not happening so like in a quick call or something. You need to have some time and to rethink really on their own beliefs. And the other thing is all the proof points. As you showed in the beginning, there are many big companies, small and big companies, that already showed that in the end it's maybe less of a risky business when you're in a steward-owned company. So proof points. And thirdly, I think putting the narrative and making sure that more people know about it, because even I have been in the impact investing field for a long time, and it was not since the beginning on my mind. I didn't think of it. I just thought about the planetary or societal solution, and now it's much more about, okay, how and when. And I think these are the three things that pop up in my mind.
I don't know how I convince. I don't know if I have ever anyone convinced, but for example, Purpose Foundation did an event in Berlin in October, and there were also many people, and also people I talked to. For example, you were referring to the people who exited their companies and now become investors themselves. And many of them are actually critical of the system that made them rich, because they experienced themselves what crazy pressure it was to have a tech VC on board that wants to see X within time Y. And they are actually saying, okay, if I want to invest my money now with purpose and with impact, but I also want to do it in a different way, and I don't want to put people's lives at risk in the way that it has been done to me. So I think that's one group that's actually quite addressable. The other thing is, you mentioned narratives and the 8 out of 10 failing. I mean, that's when I started to go into that area without having any experience. I mean, I didn't even know what a convertible loan agreement is. It was just learning by doing, and like everyone I talked to was like, what is this? Like, you want to do venture investing? Are you crazy? 8 out of 10 fail, and maybe one survives. And if you're really lucky, then you have that one unicorn. And then if you walk around and say, where does this narrative come from? I mean, that's the narrative that the VCs are producing themselves. I mean, they are always looking for the unicorn. And when you're always looking for the unicorn, you oversee all those sustainable, passion-driven companies. And then you say, okay, I didn't find the unicorn, so that's why the VC funds in general, I think almost none of them is actually delivering the return that they are promising at the beginning. So what is the narrative? What is the narrative for what is a decent return? And we just have to be much more realistic there. And if I look at my own portfolio, I think I had 4 failures. Out of those, 2 were impact companies, and out of those 2, 1 was just bad management. If you put your money on the wrong founder, then you're never going to be safe for whatever model there is. And the other one was just pushed out of business by a corporate where you just had no chance. That's just one of the classical things where incentives go against you, and if there is a big money game, and they just crush you. So if I look at all my existing portfolio over the years with Corona and with now the backlash in financing, I think most of them have been on the edge of going bankrupt, but they refuse to let go. And this is something, this purpose-driven founder thing, I really want to do this. This passion. I'm not a serial entrepreneur. I don't run around getting money from one fund, try something, get a team, it goes down. I run around, call myself a serial entrepreneur, and start the same thing over with somebody else's money. That's not what happens. And I think this mission drift is in impact entrepreneurs in general, but it's being supported by that model, by steward ownership. And I think if you take some time to talk to people, to reflect on those things, and if you question the narrative that they all come out of their business school and out of their whatever, EY, McKinsey, Boston Consulting Group, wherever they were, if you manage to question those things, you find the right person, then you can empower them. But I still believe it's still a very narrow portion of people who are actually going into this and are willing to go deep into that and question their own beliefs.
Yeah, but is there not also like a system change in the narratives on the KPI, how we measure returns, impact? You know, like we talk about impact management and measurement, we try to have some metrics that helps us define what is success, but are we not trying to measure the kind of this new type of ownership and governance model with old tools?
Yeah, I do think we are trying to do it with the old things, and maybe the impact frameworks are not that old yet, but we try to apply the old impact frameworks on the new kind of thinking. But I would like to have some new KPIs. I think we talked about it before. It's like today we count the amount of exits. So many exits have been successful. And I hope we can come to a new kind of KPI with the amount of companies that keep on existing and maybe not become really the biggest of the world, but that there are many more, that it's a distributive model and distributive economy with a distributive power. And I do think that there are new KPIs coming up, just like how long can companies in the end exist, much better KPI than the numbers of exits.
So from a VC perspective, that would be actually capping the downside scenario and making sure that the companies still subsist and survive versus having one unicorn that returned the fund, this kind of outlier framework.
Yeah, I think so.
Yeah, I mean, if you mention the unicorn, how do you get a unicorn? A unicorn, if a company, let's say Google, with what they originally did, like a search engine, why are they worth so much money? Because no search engine other than Google can exist next to Google, and by definition, something that gets so big and so powerful, it cannot have a positive impact for most people. It will always be extractive, and this framing cannot be the right one. So I'm a bit, I tend to start laughing or smiling when impact VCs tell me that they are looking for an impact unicorn. That it doesn't exist.
It's counterintuitive.
I'm sorry, but
like
can I say this on stage? That's just bullshit.
Yeah.
and
excuse your French.
Yeah, I'm sorry. No, I'll leave it there.
Okay. Last question before we wrap up. What would be an ideal fund for you to invest in? Because we talked about this new asset class that it could actually exist between philanthropy and VC, or is that supposed to replace one or the other? Can we talk about a blended type of asset class that combines a little bit of the benefits of philanthropy and venture capital?
Well, I think the real ideal fund, but that's really ideal, it's of course blended. It has philanthropy and normal investment money. It's maybe a little bit more organized, like a bank instead of the VC model. And it's trust-based, so it would be money given to an entrepreneur, and he or she could use it in the way that he or she thinks it's really needed. So no power play of the investor, but really trust in the company and trying to to make the company as successful as possible in a healthy kind of limit. I think that would be the ideal, and I would like to do it with many nice people together. So the portfolio companies, but also the investors, and really try also to protect the logic in there from everything else outside that's already built. Really try to keep strong on building what's needed on a systemic view.
And value alignment among all the moving parts.
Value alignment.
Yeah, all true. Maybe I want to add again what I said in the first answer. Like there are different forms of ownership structures. There is not only VC versus steward ownership. There is many things in between. And also, I mean, why is there a necessity for a VC and for a venture capital? Because the bank doesn't do what the bank was supposed to do, finance young companies that develop a business model. That's exactly what banks don't do. So we have to pull back banks into this game. That's a huge game changer. And then also existing investors, I mean, just ask the people you want to invest in what is their goal. Maybe they don't want to go for steward ownership because they say, hey, I'm working 60 hours, I'm taking so much effort, I want to have something from it. But they also don't want to become a billionaire. Maybe there's something in between. Maybe you have like 2, 3, 4 strategic investors who own large shares of the company. Then you have some employees who own shares of the company, and you have a foundation that some profits go to, and you have a mixed model. You have cooperatives. I mean, I'm from Germany. There it's called Genossenschaft. Much of the old school economy was based on things like that. Much of the banks were based on models like that. So it's not that we have to invent everything from new. Many things are just there, and just the public framing around VC, tech, growth, and eternity just erase them from our minds, and we just have to go back to that and just use the tools that are already there.
And leveraging the narratives and the stories so that it emulates, and because I think what is also missing is this information sharing or knowledge sharing. So I'm glad that we were here today at ChangeNOW to discuss this topic. If you will encounter any co-investors around the conference today, what would be your kind of key call to action?
First of all, do it, and don't always wait for the others to approve you that you can do it, which is also what VC funds often do. They need 5 others to tell them we also do it until they make a decision.
This FOMO type of approach?
Like if you're an investor in early stage ventures with impact,
followers,
take a decision and do it and get going and work with the team instead of waiting for others to tell you what to do.
Yeah, I think I would question the investments that you're doing. Are they really building this new kind of world we need, where there's another kind of power and a more balanced wealth behind for all of us, and not just for a happy few, so that you really look in a different way, in a more systemic way, to the investments that you do.
Not only looking at the what you invest in, but the how. So thanks a lot for all your key insights. I'm hoping that the audience got a lot of key learnings, and that they will start kind of pioneering or questioning the current model, the current language that we're using, so that we can get into more adventurous territory around corporate ownership and governance alternatives. So Astrid and Patrick, thank you very much for being here on stage today.
Thank you.
Thank you, Sabine.
Thank you very much. So we're finishing this up, and I just want to give you a few key messages from these 2 panels that we heard. First, dare to be pioneering. I think we need to be creative, we need to think outside of the box, and kind of question the usual language that we're using when we are investing. I would come back to what Astrid says. It's about an exist strategy and not an exit strategy. I think trust is paradigm. It needs to be among the stakeholders, and we need to rebalance the power in the relationship between founders and investors. And at the end of the day, what we're trying to do here is basically what nature has already done, right? It's about regeneration of capital so that it can recycle and not be consolidated in the minority. So thanks a lot for being with us, and I hope we got you inspired, and you can then go on your next journey and be creative about corporate ownership and governance model. Thank you very much.